Okay, more people are entering the room, but I think we can get started now. So first of all, hello and a very warm welcome to today's ECIPE webinar on the global minimum corporate tax. Today is September 14, 2022. It's about 1 year since we saw a consensus popping up among about 140 companies, if I'm correct, from pretty much every corner in the world on a proposal to introduce a minimum corporate tax, a tax on large multinational companies, based on a proposal that was negotiated under the auspices of the OECD's Secretariat. The EU and the US both played an important role in encouraging other governments, small and large, members of the so-called inclusive framework, to sign up to the global tax deal, which also includes another pillar 1, which is also in this discussion today, on taxing large companies on the basis of where they earn profits. Now, a year since the tax deal was agreed, material progress is still missing. Implementing legislation is hard to find. We see political divisions in the EU member states, preventing an EU-wide adoption of a corporate minimum tax among EU member states and the EU. At the same time, the implementing proposal of the US administration, the Biden administration, it does not really adhere to the OECD's negotiated standards for global minimum corporate tax rate. Businesses and tax professionals at the same time are very concerned that there will be a new web of tax code complexity, a new web of complexity that will leave companies in the dark in a way about how exactly to comply with potentially inconsistent national tax codes. And today, we want to have a debate and recap whether we actually need a global minimum corporate tax, why governments are so cautious, not only in the EU, but also in other parts of the world beyond the US. And we want to talk about potential alternative instruments that could be implemented, for example, in the EU, if EU governments continue to disagree on minimum corporate taxation. We have invited 3 experts for today's discussion. These are Elena Leontieva. Elena is the co-founder of the Lithuanian Free Market Institute in Vilnius. She's currently serving as the president of the Lithuanian Free Market Institute. And I can say this as well, Elena has recently been granted the 2022 Sir Anthony Fisher Achievement Award for her service to the liberal movement and the people in Lithuania and Lithuania's post-Soviet transition. I think this is important to mention, particularly in the context of the current geopolitical environment. Then we have Daniel Bunn. Daniel is the executive vice president at the Tax Foundation in Washington, D.C. Daniel and his team published extensively on Pillar 1 and Pillar 2, and they continue to offer top-notch analysis of recent developments in the US and globally with respect to corporate taxation, but also other types of taxes. And then we finally have Dr. Matthias Kullas. Matthias is the head of division at the Center for European Policy, a think tank based in Freiburg in Germany, probably Germany's leading auto-liberal think tanks, at least from what I can read and what I can tell. I will ask each panelist for a brief introductory statement of about 8 minutes before we enter the discussion. And without further ado, let's begin with our first comment from Elena and a brief remark and this question to our audience. If you have questions, put it in the chat box so I can refer and get back to them later. So without further ado, Eleanor, the floor is yours.
Thank you, Matthias. Tax harmonization is not a new topic in the global agenda. And of course, the question, should we move towards tax harmonization or should we keep tax competition, and why it is important if we have to stick to it? This question is still in our minds. So let me put several fresh arguments about tax competition. In the modern world, we see that money is not anymore a sign of scarcity. It's not an instrument which is used to measure scarce resources. Instead, money is becoming more and more a sign of plenitude. And for example, the ECB has increased the monetary base from the start of the COVID to the beginning of the war in Ukraine twice. Imagine, twice. So we see that there was a big space where the prices could raise when the economic distractions started and when the war started in Ukraine. So the main banks, so governments have almost inexhaustible resources coming from the monetary policy. In this case, the ability to raise taxes and tax competition becomes probably the only instrument which still forces the government to optimize their action, to streamline their functions, not to be involved everywhere and every time. Because of course, the tendency today is for the government is to be everywhere and to have no limits on the expenditure. So tax competition is probably the last resort to save the democracy, because otherwise our democracies could actually eat themselves by being involved everywhere, by the rent seeking, being financed through the state functions, and all of that is pretty dangerous, as we know. So in this context, we see the current move to harmonize corporate profit tax, which started by OECD and which is now discussed by the EU countries. Let me briefly describe the main difference between the OECD agreement and the EU directive proposal, which are quite significant. One of the major shifts was from the voluntary ability of the countries to voluntarily join the project to completely mandatory. The second shift is from being subject only to multinational companies. Now the shift is also to purely national companies. So under the new directive, every company which has 750 million euro of wealth turnover and 10 million of turnover in every single country and 1 million of profit would be subject to this legislation. And it would mean that the profits should be recalculated by new fiscal rules, and anything that is that has to be added to 15% of the efficient tax rate should be paid either to the authorities in the home country of the capital or in the domestic country. And there are certain rules which would actually make countries motivated to relieve this income at home. All these important changes have been done, but no impact assessment have been implemented by the EU and you. And the argument was that it has been already carried out by OECD level, but the changes are significant. Another significant change in the situation is, of course, inflation. We see that the numbers are fixed in the legislation, and what used to be 750 million euros just a year ago is not the same amount today. And I'm afraid tomorrow and the next year it will be a completely different estimation. So smaller companies would be subject to this legislation. We in Lithuania have a current inflation annual rate 22.4. So imagine what does it mean for companies to gradually move to these fixed estimations. As we know, Estonians proposed indexation of the amounts, but this was rejected by the EU. Probably now there is a time to revise this proposal, because the inflation is really dangerous now in all European countries. What I should say, of course, the profit tax is the least appropriate tax to being harmonized, because the complexity of profit tax legislation is enormous, and it will create enormous bureaucracy. They need to recalculate every expenditures, everything according to the new fiscal rules. And I doubt that we will have appropriate legislation, appropriate explanations. And in national tax systems, we know that the profit tax is the tax which most frequently requires explanations from tax authorities on what could be deducted, what could not be deducted, and so on. So if this moves on the EU level, it looks really, really scaring. And all these carve-outs, rules, and so on, they're so complicated that even the very good tax experts with whom we work these days feel confused. They don't know how this will be implemented. And it looks like people in the EU, those who prepare those directives, probably also have a lack of experience dealing with the corporate taxation. And another subject, maybe I could touch it in our discussion, is the deferred profit tax. And this is the model which is now used in Estonia, Latvia, partially in Poland. We in Lithuania also consider moving to this model. Actually, it was born at our institute as an idea in 1995. So it is very important to keep openness of countries to innovative approach to taxation, to be competitive. So maybe we can touch that in our discussion. Thank you, Matthias. I pass the floor.
Yeah, thank you, Elena. Yeah, the deferred profit tax, an interesting vehicle currently applied in Estonia, Latvia, originating in your institute. We'll get back to this in a minute. Now let's turn the floor to Daniel. And Daniel, please feel free to touch upon a few issues Elena just touched upon. Thank you.
Absolutely. Thank you, Matthias. Thank you to ECIPE for organizing this. As Matthias said, my name is Daniel Bunn, and I'm from the Tax Foundation. Tax Foundation is based in Washington, D.C., so I'll be providing a little bit of the U.S. perspective on this current project. The U.S. currently, as of August, has 3 minimum tax rules that apply to multinationals. Now, all 3 of these rules are unique. And they are unique relative to the OECD minimum tax rules. And 2 of them were adopted in 2017. Those 2 rules, one that provides a minimum tax rate of between 10 and 13% or so on the foreign income of US companies, and another that has a 10% rate on the tax base, based on multinationals and their cross-border transactions. So if you have a lot of deductible cross-border payments, that 10% rate might apply to you. And then the more recent development is a new 15% tax rate on the adjusted financial statement income of companies. And this is where I think it's worth digging in a little bit onto what is the purpose of these rules and why are they all unique and different. I think Elena touched on this a little bit, but one of the goals of policymakers in designing the original rules, minimum tax rules in 2017, was to ensure that the US had some authority to tax the foreign profits of companies, but it did so in a way that allowed companies to blend their income from high tax and low tax jurisdictions, and also put limits on what tax credits could be used to offset that income. And it taxed it generally at a reduced rate. But the goal of the rule was to ensure that there weren't perverse incentives for US companies to put too much of their profits into zero tax jurisdictions, and in those cases where there was a lot of income in zero tax jurisdictions because of tax planning, that a minimum rate could apply. But relative to the OECD rules, it was in some ways a completely different approach because it didn't use financial statement income. And that's where after the US adoption of those rules in 2017, this led to a conversation at the OECD about, oh, well, if the US can adopt this sort of minimum tax, maybe we can get the OECD to put forward a proposal to harmonize everything, and everybody could have the same set of harmonized rules. And I believe, as Dr. Koulas will get into in a moment, there are different challenges that the EU countries have in moving unilaterally or together, and having an OECD harmonized proposal might have greased the skids a little bit on that. However, the US, even though participating in these negotiations and having introduced legislation last year to implement a version of these rules, did not actually implement those rules in August. The US lawmakers specifically avoided adopting the global minimum tax rules because the US has been, in some ways, a first mover in 2017 with its own version of a minimum tax. And the US was looking across the ocean at the EU and seeing the troubles of getting policies through the EU Council and saying, oh, well, if the EU can't move forward on this, let's not move too quickly on these rules ourselves. However, this is where the new 15% minimum tax comes in. So the new US policy of a 15% minimum tax is based on adjusted financial statement income. And those 2 points are the only points I would say it has in common with the global minimum tax. The scope is different. Elena mentioned that the scope of the global minimum tax is for companies with more than 750 million euros in turnover. The scope for the US 15% minimum tax takes a 3-year average of adjusted financial statement income and says if your 3-year average is over $1 billion, and this is income, not revenue, then you would be in scope of these rules. There's a separate rule for US subsidiaries of foreign multinationals and when they might be in scope of this rule. And it applies to worldwide income. The global minimum tax rules apply, as Elena mentioned, on a country-by-country basis, calculating your income and your liability for each country. But this new alternative minimum tax, this 15% tax that was adopted in August, applies on a globally blended basis. And I'd say another important difference, certainly the global minimum tax has some carve-outs for payroll and tangible assets, but the US minimum tax has an even larger carve-out for tax credits. The global minimum tax rules are much tighter when it comes to tax credits. The US legislation that was adopted in August has significant tax benefits for companies that are investing in clean energy projects of all sorts. And if those tax credits reduce your effective tax rate, the 15% minimum tax doesn't worry about that. It worries about other things. It worries particularly about losses from prior to 2020. It worries about stock compensation and a few other things, but it doesn't align with the global minimum tax in a lot of ways. So here we are, we're the US. We have kind of inspired this debate with the rules that we adopted in 2017. And then we layered on another set of rules that doesn't look like anything that was negotiated at the OECD, apart from it being a 15% rate and financial income being a part of it. So I think over the next couple years, depending on how elections work out this fall, Congress and the White House will face a choice as to whether they have even a legislative majority to be able to pass further rules. In my own work, I've suggested that Congress spend the next couple years evaluating the performance of these existing US cross-border rules, figure out whether the rules in 2017 or the rule that passed just recently are fit for the work that they were intended to, and watch what other jurisdictions are doing to adopt or not adopt the global minimum tax. It seems there may be some variation, maybe outside the EU, in the way countries adopt these rules, and it would be good for the US to observe how that works. And then when there is opportunity or either a deadline because some of these foreign top-up taxes might apply to US companies and the US might be interested in claiming that revenue for itself, it will be important for the US to design reforms with an eye towards simplicity. The global minimum tax rules, our existing minimum tax rules, are incredibly complex. And I think we need a heavy dose of both simplicity and competitiveness. Thinking that the way that you attract investment and encourage economic growth is to continue to lean into the opportunities to set the US apart as a destination for investment, and preferably before all of these rules are layered on top of each other again, so that we would have 3 sets of our own minimum tax rules and then foreign minimum tax rules would be set aside. I'm not generally a fan of minimum tax rules. I think a lot of times it represents failure on behalf of policymakers to fix the underlying tax system. But here we are in a state where we have, I think, a lot of minimum tax rules in our future. And with that, I'll turn it back to you, Matthias.
Yeah, thanks, Daniel, for this comprehensive view on what is happening in the world, particularly the United States. Elena pointed to it. It all started with the political desire to simplify and harmonize things, even though simplification was probably not the priority in this list of priorities, but harmonization certainly was. Now I hear that countries, particularly the large ones, they are already diverging in terms of definitions, thresholds, carve-outs, potentially allowing certain tax credits on discretionary or arbitrary grounds. Things are getting very complicated. I suppose even more complicated than most policymakers who engage in negotiations expected. Now, Matthias, you wanted to recap why we actually need a global minimum corporate tax in an increasingly digitizing world, and also put it into perspective of what's currently happening at the EU level, given that we see diverging member state interests. Yeah, Matthias, the floor is yours. Please, again, feel free to draw upon what was already said.
Thank you, Matthias. Thank you for the invitation. Again, my name is Matthias Bullers. I'm the head of the Internal Market Department here at CP in Freiburg, Germany. And let's go directly into the topic. Within the last 30 years, we see a huge drop in the global average corporate tax rate. Between the years of 1985 and 2018, it dropped by 50%. And one reason for that is, of course, that there are a lot of multinational companies try to reduce or minimize their tax burden by using BEPS techniques, and this put a huge pressure on the corporate tax rates in the countries. And these kind of behavior creates 2 big problems. First of all, these countries that do not really contribute to the tax within a country, but use the public goods. So, for example, they use infrastructure, they use the legal system and make business, make profit there, but do not contribute to the financing of this public goods. And on the second thing is that course, there's a distortion in competition compared to companies, local companies, brick and mortar companies that are not able to use these kind of minimizing their tax burdens. And yeah, what or I discovered is that this problem will increase in the future, this tax competition, because we see a digitalization, meaning that more and more goods are provided digitally. If you think about the metaverse that was announced, you can probably imagine that a lot of things, services that are provided at the moment not digital, will be provided digitally in the future. And especially companies that provide these services can provide the service from any country in this world via the internet, meaning they do not have to have a branch within the country where they make the profit, where the customers are, but they can be located in a low tax country. And having this in mind, that we are facing a digitalization, and this makes, at least for me, the conclusion that this tax competition will increase. And therefore, yeah, I think it's I'm actually thinking that in favor of let's say reforming this tax system as we have it nowadays. And actually, I'm in favor of this OECD proposal of Pillar 1 and 2 in order to make this the tax system future-proof and especially proof for a digital world. Yeah, let's come to the situation at EU level. At the EU level, as Elena already mentioned, the European Commission proposed directive that should implement this Pillar 2. And what actually we experienced was that in first place, Poland vetoed on this proposal. And in tax issues at the European Union, you need anonymity in order to implement these rules. And Poland said the reason was that, or the Polish government, actually, they wanted to negotiate the implementation of Pillar 1 and 2 together. But actually, the real reason behind this veto was that the Polish government had some issues with its rule of law, and therefore the European Commission blocked the disbursement of grants in the Next Generation EU Fund, which is the grants is 24 billion euro for Poland. Is quite a huge sum, and this problem was overcome. And the European Commission they agreed on the disbursement of this grant, and then the Polish government also said that they want to support this implementation of this Pillar 2. And but then everybody surprised was that the Hungarian government actually did the same. And the reason behind that is the same, that the European Commission will not grant this money from the Next Generation EU Fund because there are also some rule of law issues in Hungary. And yeah, and that's where we are now at the moment. And what the latest development was that the biggest 5 countries, that is Italy and France, Spain, Germany, and Netherlands, they published a joint statement 5 days ago where they announced that they will implement this Pillar 2 in their national legislation anyway. Will it be with the EU? But if there's no consensus reached at EU level, they will do it separately. And there's yeah, usually have several ways. You can do it via enhanced cooperation. That is a vehicle that you have at EU level when not all countries agree on a certain issue. Then few countries can say, okay, we implement that. And in this case, you do not need anonymity anymore at EU level, but it's 60% consensus. And but they can also make an intergovernmental treaty where they say, okay, we just have a treaty where we implement these rules into our national law. We have seen this during the debt crisis. The ESM, for example, is such an intergovernmental treaty when governments implemented things this way, which were they not able to implement at European level. So that's in a nutshell what's the situation at European level.
Okay, thanks a lot, Matthias. That was a good overview of what's happening at the EU level. I wasn't aware that we saw this joint statement by the largest, basically, countries in the EU, which leads me to the first question. There are incentives for small and open economies and for, let's say, larger countries, which typically tend to be less open if you look at the restrictiveness of markets globally. And these incentives to engage in tax competition, they differ. Large companies have the gravity of large markets in order to attract investment and economic activity. Is this somehow reflected in what we currently see implementation appetite for a global minimum corporate tax? Also, Elena, referring to your country and countries in your close neighborhood, Estonia, Latvia, I think a consensus kind of emerged with regards to what's been tabled by the European Commission on implementing the OECD's minimum corporate tax. But is this a clear picture, a good representation of what's actually going on in these countries politically in terms of favor for implementing this minimum tax? You're still on mute, Elena?
Yeah, a good question, and let me explain a little bit the circumstances of this deferred profit tax implementation in our part of the world. It is true that for a small country, it is an important instrument of competition, but it was not implemented as a tool to compete. It was implemented because it is sound. It is economically sound to tax profit only at the point of its distribution. So in Estonia, profit is only taxed the next month after dividends are physically paid off. And you can imagine how important it is for the transparency of the accounting. I mean, the fiscal accounting becomes almost the same as financial accounting, how important it is for the cash flow in the company, especially at such fragile times. At the COVID, Estonian companies all had their undistributed reserves and were able really to survive. So, but as I mentioned, first of all, this is economically sound. And I guess this is the reason why Estonians and others want to keep this system. We believe that this is the future, and we want to be the small islands of liberties in this world. And I'm very happy that this model became legitimate according to the OECD and the EU directive rules, because the risk was that it will be shifted from the legitimate domain at all. So now it is legitimate. Countries which already use it can continue to use it. There is only one rule, that the profits of those bigger companies would still have to be recalculated. And once in 4 years, the minimum effective tax rate should be paid to the state. But to countries which would opt for the same deferred profit tax later, there would be a more discriminative rule. We would have to allocate profits every year. So I think this is not fair if the European law looks for the equal playing ground. The countries which opt for the same rule should be able also to use the same rules as do Estonians, Latvians, and Polish. So this is very important. And following on what Matthias was saying, said, and Daniel, I also had a clarifying questions. Maybe we could make a little ex ante practice here to Matthias on this digital taxation. Wouldn't a simple tax, sales tax, would be a more appropriate and transparent solution to the problem that you were describing. And to Daniel, remember the Polish counter-argument to the directive was very sound. They said that if Americans do not implement Pillar 1, there is no economic sense for Europeans to implement Pillar 2. So what do you think about the logic of this argument and its validity today? Thank you.
Yeah, thanks, Elena. I'll get back to your question in a minute, but let's get to Daniel to address your question. Your second question.
Yeah, thanks, Matthias. I want to address two things. One, to Elena's question, Pillar 1, I think, regardless of the US interest in that project, seems to be extremely bogged down. There was an OECD consultation on Monday where it seems that the OECD was interested more in figuring out which types of complexity people were referring to, as opposed to paying attention to the whole thing being very complex and difficult to administer and understand. There are a lot of underlying problems with that project, but I think the Polish concern about US adoption of Pillar 1, I think those concerns are sound. I myself wrote in a response to the OECD consultation that I think it's very unlikely the US Senate would have the votes to approve Pillar 1. So if those two need to be tied together for political or economic reasons, I think those concerns about US passage of Pillar 1 are valid. I want to mention something about the Estonian tax system and tax revenues in developed countries overall. Dr. Kulas was accurate in saying that corporate tax rates have fallen significantly over recent decades. What has also happened is the corporate tax base has been broadened in a lot of countries so that the tax to GDP ratio for corporate taxation has remained relatively stable, and corporate tax as a share of total revenue has also remained relatively stable. So tax to GDP around 3% among OECD countries, and the share of revenue from corporate taxation around 10% over that same time window. And in Estonia, similarly to France and Germany, the Estonian corporate tax system raises about 2% of GDP. So these different models of corporate taxation, while very different in design, can raise similar levels of revenue relative to the size of the economy. And I think it's important to think about like the different levers for tax competition. So if you look at, say, the French approach with a patent box, a reduced rate, or you see significant tax credits in some countries. Germany recently adopted a research and development tax credit. There are all sorts of ways countries choose to carve up their own tax bases for competitive reasons, and not just the corporate statutory rate. And I think what Estonia and some other countries have chosen to do is to make the base as simple and straightforward as possible, and not create all these purposeful loopholes for different activities that I think follow along with the competitive pressures. So I like to talk about principled tax competition a lot of times, where the principle is really simplicity and transparency. And I think that gets to Elena's point about sales taxes. A lot of countries and the EU has gone through a major project on this, digitalizing the VAT system and ensuring that low-value goods bought off of digital platforms are part of the VAT base. And I think that's a reasonable approach to ensuring that there is tax paid on these transactions. Now, I recognize that's not profits, but it gets at both the value that's received in the market, and it gets to a lot of this cross-border transaction without a local physical presence. So I'll stop there and pass it back to Matthias.
Yeah, thanks, Daniel. To get back to Elena's comment on the digital services tax, I looked into the digital services tax extensively, including the impact assessment that had been conducted by the new Commission at the time. A digital services tax is not fit for the purpose of creating additional investment in digital services in the EU, nor is it fit for improving social justice. It might impact on the perception of social justice. It might raise the perception that policymakers do something about it, including the imposition of a minimum tax for large, big businesses from somewhere else in the world. But we must all bear in mind that the corporate tax is being paid by all of us. It is being passed on by companies to workers, depressing incomes. It is passed on to consumers, increasing prices for goods and services. It is also passed on to some extent to the owners of companies, but it will not have a significant impact in, for example, wealth or income inequality reasons that we often hear from tax activists in the debate about corporate taxation. So referring to the incidence of corporate taxes, that the corporate income tax is passed on to others, us as individuals. Now, Daniel, you write that governments globally currently engage in what you call strategic patience. You also argue that the debate has lit a period of inactivity. Nothing is really happened. Do policy makers actually fear that imposing a new tax, a global minimum corporate tax, would actually impact on prices, for example, prices that consumers pay for goods and services provided by large multinational corporations and their subsidiaries in a time in which we have extreme, compared to the past decade, inflation rates? Do they basically deviate in their actions from what they told beforehand?
That's a good question. There aren't a lot of studies that point to a connection between profit taxes and prices. The ones that do, it really depends on the local market and the size of the companies being affected. So if a company feels very comfortable passing along its costs to its consumers because it has pricing power in a market, then yes, a corporate tax increase could lead to higher prices. One thing that I think about in these days, and not just with the minimum tax, but with the windfall taxes that have been discussed, is the supply side of the economy. And what corporate taxes do generally for incentives to invest and earn a profit. I think this is an area that we should be concerned about. I think for the EU, there's a lot of talk about the digital transition and the green transition, and these require a lot of business investment, a lot of investment in infrastructure and planning and massive projects. And I think it's worth considering whether these higher profit taxes are going to impact the ability or the types of projects those companies are going to take on. Now, governments could say, well, it doesn't matter, we'll tax the profits, we'll just give them subsidies on the back end. And actually, that's how the policy works. There is room for subsidies directly from governments to companies, but not necessarily low rates of tax. So it's an interesting kind of approach that permits governments, essentially, even if they agree to the global minimum tax, to provide handouts to the companies they choose to do, and just collect taxes from them through the top-up mechanism. And this is actually almost exactly what Switzerland is looking at in its implementation, being able to have a federal 15% top-up and then turn that into a distribution to the cantons, and then the cantons kind of expected to turn that into subsidies for companies. So it's a little bit of a disjointed approach, but I think on your key question about inflation, I'm not sure that there's a huge concern for that in the short term.
Okay, thanks, Matthias. Let's assume for a second that EU governments do not come to an agreement with regard to an EU-wide implementation of the corporate minimum tax. What would be alternative instruments? Also, taking your view that you are basically in favor of corporate minimum taxation and the consensus that was achieved at the OECD level, and perhaps also recognizing that the global economy is currently, I think, even constantly undergoing a process of transformation, digital transformation. It is becoming not only more digital, but also more collaborative, producing a larger diversity of products, services, technologies that are exchanged across borders, not only in the EU, but also between EU countries and non-EU countries. Taking all this into consideration, would it also be an alternative to exclusively focus on solutions like the one agreed under Pillar 1? So just taxing companies on the basis where they make revenues, or as in Pillar 1, earn profits.
So yeah, thank you for this question. Actually, that the European Commission made a proposal on this in 2018, actually, where they wanted to implement a so-called significant digital presence, meaning that they can tax profits of digital companies or of companies that they made with certain products, especially selling data from users, but also showing advertisement to users online. And the third thing is about connecting, say, sellers and buyers on a platform. That was one thing. And the problem is that you have to renegotiate a lot of double taxation agreements between a lot of states on the world, and therefore the European Commission said this is nothing that you can implement in a short term, but in a long term. And but on the EU level anyway, this proposal does not find support of a lot of member states, so it's still out there, so it might be taken up again, but for quite a long time it's not negotiated in the council anymore. And what the European Commission actually proposed is a short-term instrument in 2018. At the same time, that they want to have a sales tax on these sales of data from users, but also revenue from showing advertisements. And the problem is that actually, in order to tax these, to implement such a sales tax, the Commission said you need a kind of a nexus. So you're not able to just implement a sales tax under the current tax worldwide system. And what the Commission said, that users contribute in digital markets to the product by liking, by commenting, by uploading, and even by providing data. And therefore said, okay, in a situation where the users contribute to the product, then we can tax this user contribution. And therefore they suggested this 3% of sales tax on the on the revenue of these sales. But as I already mentioned, it's not a big sum. And actually, Annette was really interested to see whether this kind of tax is passed to the consumers or not. I've read articles that it's not, but there's some empirical evidence from Austria that it was passed to the consumers. So yeah, that's what's discussed at the European level. But yeah, the other things that are discussed at the moment is this fair share for OTTs, meaning that this big digital companies that are responsible for a lot of traffic might contribute to the infrastructure, digital infrastructure that need to be in place in order to deal with this increased traffic that will come in future. And that's actually another thing that is that is discussed at the moment in order to see whether it's possible that big companies that make profits in the EU also, let's say, contribute at least not to the taxes, but in this case to the building up the infrastructure, digital infrastructure.
Thanks a lot. This seems to me that governments can become very inventive with regard to justifying certain approaches for taxing companies, or at least certain business models of companies. You could argue, I mean, I question, for example, why tax code should distinguish between products and services that are sold digitally or via by physical means. You know, a French cheesemaker is exporting cheese to the US, which is subject to sales tax in the US, but the profits from selling cheese to the US, they are exclusively taxed in France. And where do you draw the line? Is it, you know, small company, big company, digital, non-digital, or less digital? And all this opens up room for discretion and potentially retaliation. So the system beyond tax, also trade and regulatory policy, gets ever more complex. So I can very well see that there is need for global collaboration, but I can also see that current approaches, and particularly in corporate taxation, they need a full overhaul. Yeah, let's talk a little bit about what needs to be done. What is the next big thing, irrespective of whether a global minimum corporate tax is implemented by 136 countries or a majority of these countries or not? What is the next big thing in corporate taxation? Daniel, let's start with you, because I feel that you are the one who is in this debate for the longest time.
So the next big thing, I think, is, you know, to go off of what you were just saying, Matthias, is the intersection between tax policy, trade policy, and regulatory policy. Unfortunately, despite my preferences for broad-based, low rates, neutral approach to business models and sectors, I think what we are seeing with, again, with some of the windfall profit taxes that we've seen proposed, with the digital taxes, with the taxes on, like Matthias was saying, the heavy internet traffic kind of companies, is what I would call an excise mindset to corporate taxation. Now, excise is usually a term that you think of, oh, we're tackling something that has a negative impact on society, whether it's alcohol or emissions or something like that. But what we're seeing is an excise approach to profits, where you're thinking, oh, this type of profit, oh, I want to tax that away, or this type of profit is creating externalities in my market. And I personally don't think profit taxes are well suited for that mindset, because you end up with layers and layers of complexity, and you're not able to monitor whether you're actually hitting the mark with reducing the whatever negative effects you think you're tackling. And what I think is generally the right approach is the kind of broad-based, low rate, but particularly with respect to making sure that the government doesn't stand in the way of business incentives to invest. Now, in that context, there's still significant room to raise a lot of revenue from business profits, assuming the economy rebounds and we don't, slide into as deep a recession as we might. But it's important to think what the role of profit taxation is. And what I observe is this excise mindset being applied to profit taxation. And I don't think that's a good approach for tax policy.
Elena, would you like to add?
Yes, I would love to add. exactly as Daniel pointed out, it is this mentality that there is something wrong with the profit, and the mentality that a true investment can be done by the state. Sorry, the state may provide money, but this is not a true investment. And what we see today is this a replacement of investment, which is based on a genuine profit as a sign of the need for the society, as a tool of efficient allocation of resources. We do not remember that this role of profit is important. We do not appreciate it as a society, and we move to this very narrow-minded idea that a central authority can do a sound investment. Sorry, but most of those investments may turn to be malinvestment. And by killing the profit as a necessary tool in our society, we are reducing the overall efficiency. And reducing of overall efficiency means reducing welfare. So today is a really crucial moment to recover the understanding why profit is an important tool of the humanity in general, why it is important to let people invest from the profit that they have been gaining, how the crisis could be shortened by investment, and how the crisis may be deepened if there is no investment. We will have a double crisis if companies do not invest now on appropriate level. If the government takes over the role of a main investor, it will be a disaster sooner or later. So I get this minimum profit tax is a good moment to look on the overall morality of profit institution, role of profit institution in economic allocation of resources in a free society. And if we keep that, we can keep our democracies going.
Yeah, I agree. And I'd love to see more policymakers listen to you and others to work towards more responsible governments who not only take care about, social justice, but also efficiency in government and the private sector. Before we come to a close, let's allow Todd Bill to raise a question. He raised his hand. I don't see more questions, unfortunately, but Todd, please go ahead.
Can you hear me?
Yeah, we can hear you.
Okay. I just wanted to know if the panel could say anything about the risks that business could face if they're faced with multiple minimum taxes in the coming years. We're talking about what we have in the US now. Daniel mentioned 3, but in addition, globally, we have the OECD one. And in addition, we now have a few EU states that may adapt their own one. It may be based on the OECD one, I suppose, but then you could have other countries lacking this minimum tax. Could someone talk about just the challenges that that businesses could face if you have all of these different tax regimes? Thank you.
I'll jump in on that if that's okay, Matthias. I think the risk is really a risk of having the right information to your tax authority and the right payment. I mean, that's the same risk in a lot of cases for corporate taxpayers, but in this case, it's expanded. So companies usually keep at least 2 systems of books, one for the tax authorities based on tax law, and one for the shareholders based on financial accounting rules. And now we are saying in the US, we say, oh, you've got your usual tax rules, you've got your financial accounting rules. Now you have this third set for this other financial accounting rules. And then the OECD rules are different enough that you might have to have a 4th set. And there are all sorts of risks to, be able to maintain the right data and the, right payment structure and all those sorts of things. And it's it's a compliance burden, but it's also a burden on the administrations of different, finance authorities to be able to audit and say, oh, you did pay the right amount under this different regime, and how these numbers work together. It's not all that clear.
Okay, any other replies? No, if that's not the case, then let's get to the closing comments. Let's start with you, Matthias. Should the Big Five go ahead with their implementation plan and kind of draw a line between smaller countries and larger countries in the EU? Elena, what would be your recommendation to smaller countries, including the Baltics? Should they set up a coalition to, stop kind of isolated endeavors by the larger countries? And Daniel, what should be the responses by the US and potentially other countries outside the EU? Matthias.
Okay, yeah, it's me to start. Thanks. Actually, just like to point out to come back to your previous example about the cheesemaker that's selling its cheese in another country, the French one, and actually, if it's let's say if this development continues, that companies make business profits in countries where they're not located, I think we have to really rethink the system, and we should get aligned with this, and maybe not even for digital products or services, but also for products. But this is one aspect that I want to highlight. But I actually want to support what Daniel said. Of course, the other things about discussing windfall profits, that the governments say what profit is right, what is the right height of a profit, is it really earned or is it windfall? That is really opening the Pandora box, and that's usually governments are not the one that should invest, and the investment they take are usually not the best ones that should companies do. And therefore we should also, it's really important, of course, that you have a system in place where you have profits, where you just provide incentives for companies to invest. So let's that on a closing remark. Thank you.
Thank you. Elena.
Yeah, the small countries already have this possibility to delay the implementation of the European directive after it will be approved, if it will be approved. So my hope is that in those several years that we will have this delay of implementation, we will see a lot of movement inside the EU, a lot of failures. And remember what happened with the BEPS and other initiatives. It always looks like now they will resolve the problem. Now everything will be, taken care of. But the life is more wise than the legislator. So I guess that we will see the failures of tax legislation in the European Union. And probably that will be a moment when the bigger countries will see those small islands of deferred profit tax, countries which are not covered yet by the harmonized tax. And probably the decrease of overall welfare will be a good impetus to look at the more transparent, simple, easygoing systems and much more competitive, because of course the global competition will not disappear from our agenda and it will become even stronger. So that is my hope.
Okay, so policymakers should not waste this crisis. Daniel.
Yeah, so from my view, I'm staring down several deadlines for Congress. The first deadline will be the time in which a foreign country adopts a minimum tax, and that minimum tax applies to US companies. I don't know when that deadline is really, but I imagine if the Big Five move forward, that it will be in probably 2025. There's also another deadline, which is in 2026, when the tax rates on 2 of our 3 minimum taxes will increase. And all of these two sets of deadlines create an incentive for Congress to be thinking about what it should be preparing for as those deadlines approach. And if, from my view, there's any opportunity to simplify the rules, even in the context of maybe making them a little bit more compatible with the OECD rules, but also ensuring that US companies are able to continue to invest and succeed, then I think that's what Congress should focus on, making sure that as they're evaluating what other countries are doing, and as they are looking at these deadlines, to focus on, in some ways, US interests, but also being able to say sometimes US interest needs to be aligned for compatibility for the sake of simplicity.
Okay, that was a clear statement. Thank you very much to all our panelists. It was very nice to have you here to listen to your views and perspectives, to your outlook. Thanks also to our audience for taking the time to stay with us until the end of our session. We hope that you have a few takeaways that you can benefit from, not only professionally, but also in your conversation with friends and family, because I know there's a lot of stuff that needs to be explained when we talk about corporate taxation. So thanks a lot to all of you. It was nice to have you here. See you soon. Bye-bye.